Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at WisdomTree Asset Management. I have with me today a recurring special guest, Mr. Chris Acito, CEO of Gapstow Capital Partners. Chris, great to have you on again.
Kevin, thank you for having me. Look forward to our discussion.
Absolutely. So, what we wanted to do is bring periodic updates to what's going on in the world of credit, specifically in this case, say accessing private credit. For those of you who may not be aware, Chris and his team partnered with WisdomTree more than 4 years ago, pioneering access to the private credit field, which really, did not have that type of availability for individual investors. And we used an ETF wrapper using Chris and his team's work to come to market with that. So we like to say we were early to the private credit, alternative credit party. But Chris, before we go down that road, I wanted to just give us a little update. What's going on with traditional credit? So, we did see some widening out in spreads immediately after Liberation Day in April, but we've really come right back in again. So what are your thoughts when you're looking at, say, traditional investment grade or the high yield markets now?
Well, I must say, Kevin, I think I'm exhausted. You very, very blithely said Liberation Day, and now we're back to normal. What a ride that's been, huh? If you think back to Q2, we had Liberation Day, we had tariffs, we had daily policy changes, we've had an assault on Federal Reserve independence, we've had a downgrade of U.S. credit risk, we've had a war in Iran, including U.S. bombings. We've had a big, beautiful bill passed with huge implications for debt. So, I don't even know where to begin on all of this, Kevin. But yes, your summarization is correct. We had spreads blow out a bit with some of those early pronouncements, but it is amazing when you look end to end over the second quarter how things not only turned around, frankly, at least in the credit world, things finished up a bit. Because of the, in general, spread tightening, offsetting maybe a little bit of interest rate risk, but also with a higher carry to not only investment grade but high yield. Positive quarter, unbelievable as it may sound.
So, gearing the conversation towards private credit, it really, when I go in and I speak to clients, invariably the topic comes up nationwide, depending upon where you are, a little bit more interest than others, I have found. But I think for a lot of people out there, it's an interesting term, private credit. Just give us a sense, a quick 101. What are we talking about with private credit? Just so everybody is aware what it is we are talking about.
Yep. Good question, Kevin, because it's something that I think everybody has become familiar with the phrase, but variations different. I'll stick to corporate credit as an example. The distinction public and private in the high yielding space is for public bonds or broadly syndicated loans. The traditional public aspect of it was that these were bonds underwritten by an investment bank and broadly distributed, broadly syndicated, so to speak, to a very broad network of investors. The private credit market is a little bit different. They are still below investment grade loans made to corporations. The difference being they are typically bilaterally negotiated between a private lender, meaning a non-bank lender, and a borrower themselves. This can be done for several different reasons, including customizing the offering and the loan terms through size, and as a result, because of those tailored dimensions to the, so to speak, private credit, those loans tend to get a higher yield than would a traditional high yield bond or leveraged loan.
So as I mentioned in the opening, more than 4 years ago, we partnered for the WisdomTree Private Credit and Alternative Income Fund, ticker HYIN. And it's based upon your guys, the Gapstow Index, GLACI. So give us a sense, what sets GLACI apart than, say, some of the other more Johnny-come-latelys that we've seen come out there in terms of their solutions?
Yeah. Well, I think we had the approach of a diversified approach when we started the product, Kevin. That as much as I used corporate credit as an example just a second ago, really the idea was could we bring together several different types of alternative credit exposures. So the GLACI index to which you refer reflects not only private corporate credit, but also those types of loans made to commercial real estate borrowers and individual borrowers, particularly households looking for mortgages for in the residential markets, in addition to some structured credit and traditional high yield bonds and loans. We wanted to make sure that the GLACI index and therefore the product that tracks it had a broader, more diversified set of credit exposures than, say, somebody who just focused on BDCs or someone who just focused on mortgage REITs. We wanted that broader group because in the end, as much as we love to speak about a singular credit cycle in the U.S. or other economies, in fact, there are multiple ones. That commercial real estate industry dynamics are very different than corporate, that can be very different than household balance sheets at any point in time. And it's nice to gain exposure to all of those that don't move perfectly in sync with each other.
So investors, they like hearing it, right? A lot of people like to hear, well, it's a hot topic in the investment world right now. So if you are looking to access private credit, use it in your portfolio, where would you think it would be a best fit? Is it a standalone? Is it a complement? Is it a little bit of both?
I would say a little bit of both, but let's try to be more specific about that. First of all, I think for people looking for higher yield, and by that I mean a distributable yield, a dividend, the index and the product related to the index, HYIN, is a very high cash generative product. And for people who are looking for that sort of income and maybe have a part of their portfolio dedicated to income generating holdings, HYIN would fit very well within that. The index and the product are designed to produce and have for a while a yield that is greater than 10% on an ongoing basis. And so it's an income generating tool for some people. That said, there are other people who have begun to craft a credit portfolio into and of itself, almost a new asset class, Kevin. It's rare when we actually introduce a new asset class into our general portfolio theory, but I think people are recognizing that credit is distinct from equities, is distinct from traditional fixed income, and therefore sometimes take the approach of actually carving out an allocation specifically for exposures like the ones we're talking about.
So, from a bottom line perspective here to kind of, bring it all together here, wrap it up nicely, would you suggest that an HYIN, a private alternative credit type of solution, is more of a strategic than a tactical type of strategy investors should be following in their portfolio?
I personally, Kevin, feel very strongly that I do think credit has emerged as its own asset class. And once you establish that as a primary part of your portfolio, the tactical element goes away, that it begins to be, as you said, a strategic part of your asset allocation, an ongoing piece of the asset allocation, just as you might have had it to commodities or fixed income or equities or maybe private equity if you're active there. Credit really is a distinct asset class, in my opinion, requires special expertise to gain exposure to it, and therefore I think has moved from perhaps an older dated version of credit investing, which is waiting for a distress cycle, which is very opportunistic, to, I think, a newer view that's emerged over the last 10 years, which is actually it should be a standing allocation within your overall portfolio.
I couldn't agree more. It's an interesting conversation to have, especially on the fixed income side, as it continues to garner a lot of attention and headlines out there. So Chris, thanks for coming on. We're going to continue to maintain this dialogue throughout the course of this year, next year, and the year after, hopefully. But once again, Chris, thanks for your thoughts. I really appreciate it.
Kevin, thank you for having me on. Always love talking credit with you.
Wonderful, wonderful stuff. So that's it from here. Have a great rest of the week, everybody, and be well.